And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday as we get, really kind of kick the month of June underway. As we talked about yesterday, first trade day of June yesterday. Market trade a little bit sloppy. We'll get to that in a minute. Of course, the question is how do, now we're moving into summer, how do summers typically work out? Now, the month of June tends to be fairly decent in terms of a market rally through really about the first 2/3 of the month. So the market tends to rally in June. That doesn't mean every single day. It just tends to be higher in the month of June through about the 20th of the month. And then from the 20th to the end of the month, the market tends to be weak. Now that's just seasonal tendencies and that's, historical averages. It doesn't mean it's going to work out that way exactly. But the month of June tends to be better at the front end, weaker at the back end. We'll see how that works out this year. A couple of interesting stories out. E-Trade talking about potentially banning Roaring Kitty from the E-Trade platform for potential stock market manipulation. This all revolves around the GameStop saga that has now returned. We went through this whole GameStop issue before. GameStop went running off to the moon, crashed. It's now back on a run again as Roaring Kitty has returned back into the forefront on Reddit and YouTube, talking about his ownership in GameStop. He posted out yesterday after the bell that he still owns his 5 million shares of GameStop. So that's gotten everybody very excited. But now E-Trade saying, what you're doing is kind of market manipulation, because when you make a post like this, it causes people to go out and buy the stock. And there is some truth to that. If you have the ability to move a market in one direction or the other, you got to be a little bit careful with that. So we'll see what happens. But, this is, obviously if E-Trade, bans Roaring Kitty, or if the SEC does something, in regards to Roaring Kitty and potential market manipulation, it's going to be interesting to see the uproar. This has gotten down to be more of a class fight between the retail trader and the Wall Street giants. And of course, it's the battle of the Goliaths between the two. And, we'll see how this works out. But it's going to be a very interesting story to kind of see how this unfolds. But again, GameStop was up about 100% yesterday morning, closed up about 48%. So, again, if you bought the shares at the open yesterday, you didn't do so good. If you owned them beforehand, you had a decent day yesterday. GameStop looks to be opening down about a couple of points this morning. So we'll see what happens here. These speculative booms and busts happen on a regular basis. So again, it's just, it's interesting. I like watching these things. They're good stories. I don't recommend doing them. You can lose a lot of money doing this, but they're fun to watch. Outside of that, a couple of other things. Economic data continues to be weaker than what was expected. Again, it's something that we had talked about previously. I've written about it a couple of times over the last couple of weeks. That economic data was showing a lot more weakness than maybe what the headline suggested. Kind of some of the major reports seem to be okay, employment, et cetera. But you look underneath the surface and retail sales, those type of things, that economic data has been substantially weaker over the last several months, and it's beginning to show up in some of those big major headline reports, like GDP as an example. The Atlanta Fed entered into quarter two, so their first estimate for quarter two from the Atlanta Fed on May the 1st was over 4% GDP growth for the second quarter. Just since then, so a month later, that estimated rate of growth is now down to below 2%. And that's because of this weaker data we've been seeing coming in. ISM services came in weaker than expected. ISM manufacturing is back into contraction. So again, this slowdown in the economy is certainly manifesting itself. This is what the Federal Reserve has been kind of watching for, is this lag effect of higher rates to catch up with the economy. That's now occurring. And consequently, the expectation for rate cuts is now back up to 2 for this year after yesterday's data. Of course, this is just, kind of the byproduct of this, and that, we had this big lag effect of all this money, et cetera, that was injected into the economy. It's beginning to show signs that between higher living costs, higher inflation, and the inability to go out and get more credit, that consumers are now kind of running into the problem of consumption. Of course, that's what everything drives on. We've got big retail inventories going to have to be liquidated. That's going to have to come off at lower prices. One thing we did note in the manufacturing and services report is that price pressures are easing on producers and service providers. So we are seeing that this inflationary input coming into the data, which will eventually transfer into the economy. But that's all slower demand. And so that suggests that economic growth is going to be weaker. Now, that data did come out yesterday, and the market did sell off in the morning. Now, one thing we've seen over the last couple of days is some kind of bullish support for the markets. So here's what you need to know before the bell this morning. Market opened up weak yesterday morning, kind of flopped around in negative territory most of the day. It wasn't a great day. There wasn't a huge amount of strength in the market. But at the end of the day, the market did rally back into positive territory and ended in the green. So, and we've seen this over the last couple of days. We saw this yesterday and we saw this on Friday, because on Friday we had a very sharp sell-off in the morning that tested the 50-day moving average. We talked about this yesterday. And the market rallied back above that 20-day moving average on Friday, holding that support line. Yesterday, exactly the same thing. So we're continuing to kind of bounce right along that 20-day moving average. This morning, futures are looking to open down about 25 points. So we're going to challenge this 20-day moving average again right out of the gate this morning. The question is going to be whether or not this buying that's been occurring, and we've seen this kind of late-day buying over the last couple of days in particular, is coming in right at the last hour of the day. So we're seeing institutions step in and buying stocks, right now, at least. And that's mostly what happens right at the end of the day, is this institutional buying comes in right at the end of the day, right before the close. And we've seen that. So that's actually a good sign, because it's showing that we've got some buying power coming into the markets, and late day rallies tend to be encouraging, especially when in the action we've seen yesterday. Now, this is all occurring in this backdrop. We've still got this sell signal, which again is limiting the upside to the market. So again, this morning the market's going to open down. If we get some buying at the end of the day, we'll probably wind up about where we are, where we start the day, close the day yesterday. So, again, while the markets are doing okay, right, we're getting some green candles here. We're definitely seeing some buying come in the markets. Markets really aren't going anywhere because we've still got this sell signal in place. And this could last for a little bit longer. It's not uncommon for a sell signal to flip back to a buy signal at a fairly high level. But even if we do, because these signals are at fairly high levels right now, suggests that upside is going to be somewhat limited. So again, you can certainly hold on to equity positions right now. There's really not much to be overly concerned about. There's not a lot of negative outlook technically for the markets right now. We just kind of continue to be consolidating here in this kind of sideways manner. That's okay, because that's working off that overbought condition we had previously. So that's all working into our advantage. The market's kind of holding up right now. Again, that 50-day moving average is really the line in the sand that you want to pay attention to. As long as we stay above that, there's really not a lot to worry about. Mostly just look at the positions in your portfolio, make sure that just there's not a single kind of company that's falling out of bed for one reason or the other. But other than that, just maintain your allocations accordingly, at least for now, relative to your risk tolerance. Again, there's not a lot of downside risk in the markets at the moment, even though there's also not a lot of upside available. So again, until we resolve that sell signal. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn. Got a few stories to get into this morning. Big crash on the markets yesterday. Berkshire Hathaway went to zero for a moment. We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So this morning, John Penn joining me. So yeah, yesterday I got a couple of panicked emails from individuals because their stock went to zero. And Barrett Gold was one of them, along with Berkshire Hathaway yesterday. And it was a glitch. It was a computer glitch, software glitch on the New York Stock Exchange that affected the bid price. But yeah, for a moment, people were like, oh my God, what just happened? You know, it just, my stock was at $79, now it's zero. You know, unfortunately, that is very shocking if you have to be looking at it full time. If you don't look at your portfolio, all day long, which you shouldn't do, you didn't notice because it was all fixed by the end of the day. Everything was fine. But yeah, it's certainly a shock when things immediately go to zero and there's no headline, right? There's nothing that says, anything that happened. It just went to zero. So we'll see.
Yeah, that happened on a Monday, too. So it's like, Monday. Hey, that's a great way to start the week right there. Hey, thanks, y'all. Yeah.
Exactly. So a couple of things. So I got an article out this morning on the website talking about deviations from market from long-term growth trends of the market. And, basically it's just it's a thought exercise more than anything else. But I wrote a similar article to this back in very early 2022 and saying, hey, markets are really extreme here. We're extremely deviated. And of course, this was coming out of all that, $5 trillion in stimulus and quantitative easing, et cetera. And markets had gotten very extended, very deviated from long-term mean. In fact, back then, we were trading at about 148% of the long-term exponential growth trend. So, so we start taking a look at these massive deviations, and at some moment here, Brent's going to bring the chart up for you. So, so when you start looking at these long-term deviations, they have typically aligned with major market peaks. Now, again, that doesn't mean immediately, right? Things can certainly go a lot further and longer than you can possibly imagine. But, these kind of big peaks of deviations from the exponential growth trend of the market typically tend to go through a reversion process. And the reason is simple, is that the markets can't outgrow their fundamentals indefinitely. Price can only go up so long, but the underlying growth of the market comes from economic activity. And so if economic activity is slowing, earnings are going to slow and prices will eventually correct to adjust for slower fundamentals. We just haven't gotten there yet, right? And because, inflation's coming down, corporations are cutting employees, et cetera. They're able to boost their profit margins and they're able to boost earnings through buybacks. So right now, earnings look okay and profits look okay. So the market's doing fine with that. And we're back to a very big deviation from that long-term growth trend. It can certainly get worse before we get better. And we kind of have a watermark now at 148%, right? So, the last time that we were even near that level was the peak of the bull cycle back in about 1905, actually. And we were at 144% back then. So, it's a very elevated level that we're at. And it can certainly set a new record. There's nothing that says that it can't. But importantly, valuations track exponential deviations, and it's because valuations are a function of price and earnings. And so if you take a look at valuations, its deviations also getting fairly extreme. Not as extreme as the market is from its growth trend, but valuations are also getting fairly extreme, which suggests that future growth in the markets is going to be somewhat slower without going through some type of valuation correction in the process. So we'll see what happens. But it's important to remember that valuations are a terrible timing metric for managing your money. You should never use valuations to try to manage your money. And the reason is that valuations are a function of psychology. And that's it. And the reason that valuations are elevated is because people are willing to pay more for what they believe earnings are, right? And they're willing to overpay for them. So valuations and market bubbles and psychology, they all play together. And if you take a look at our consumer confidence composite, which combines the major measures of consumer confidence, there's a very high correlation between consumer confidence and the markets and market valuation. So it's not surprising that with consumers, their confidence increasing here recently, that valuations have been rising as well since the lows of October of 2022. And it's just a function that market cycles and valuations are a function of psychology. And so it's always important to remember that, because a lot of people make the mistake of valuations are high, I'm out of the market. That's a terrible way to manage money, because valuations are very slow to mature. And they can go a lot further than you think they can. So valuations as a timing tool are terrible. What they do tell you is what returns are likely going to be over the next 20 years, right? And so that suggests that returns over the next 20 years should be somewhat lower than they were in the previous decade. So again, it's just things to be aware of, because investors are getting very exuberant again in terms of their allocations towards equities. If you take a look at household equity ownership versus the S&P 500, it's nearing an all-time record. Last time we were this high was back heading into 2022. Again, doesn't mean that we can't set new records of household equity ownership. We certainly can. But we are certainly at levels that have been much more exuberant historically than we've seen in the past. And the same thing goes with the American Association of Individual Investors. If you take a look at their allocations to stocks, bonds, and cash allocations have dropped back to near historic lows. Bond allocations remain about normal. Their equity allocations are approaching, previous peaks. Again, just they're very long equity right now. They're all kind of one side of the boat. And again, nothing wrong with that at all, right? It's just a function of the market. Remember, markets are about function psychology. We see the same thing with the volatility index. There's absolutely no concern about a crash in the markets at the moment. Volatility index is trading at extremely low levels. Markets rising to all-time highs. There's no concern about a crash right now. So again, you can kind of understand why when you go through a period of time where things are just kind of going up and up and up, like we saw, and it's fascinating to me, right? Because last June, July, we were talking about a 10% correction, and we said back then, when you get this 10% correction, it's going to feel a lot worse than it is, because the market's just been going straight up. And sure enough, we got a 10% correction into October, and you would have thought that, the bear market had just resurfaced and we were in the middle of the next financial crisis from investor attitudes and sentiment and phone calls we were getting and just sheer panic about the decline of the market. It was just a 10% correction. That's all. It's completely normal. Since then, we've had this massive rally. And if we take a look at that sentiment index that we just talked about, combine that with the VIX, right, and make a composite indicator out of that, that sentiment VIX composite is back to more exuberant levels as well. So it just suggests that, this current AI move that we're in, where we're all chasing kind of one asset class, is just kind of getting ahead of itself. And we're likely going to have at some point, not today, not next week, not next month, but we're going to have another 10% correction or so. Eventually, something's going to happen, and we're going to have a bigger reversion, 20, 30%, because we have to work off that excess deviation from the long-term growth trends. That's got to be worked off at some point for the market to be able to rally again. There's just limits to how far the market can rally above its ability to grow earnings and revenue. So it's just something to remember. Again, this isn't a, go sell everything conversation, because I'm not saying that at all. I'm just saying is that we have to expect really two things. One is that we're going to have a correction of sorts at some point, and so we need to be aware and keep a watch out for the signs that is beginning. We're not there yet. And the other is that future returns are likely going to be a lot lower than the past returns were. So over the last 13, 14 years, we've been generating 15% rates of return because of tremendous amounts of liquidity from the government, the Fed, everything else, zero interest rates. Going forward, unless we're going to stick in another $44 trillion along the way in repeated QE programs and repeated government interventions, it's going to be hard to generate that 15% rate of return. So returns are likely going to be lower, probably somewhere between 6 and 7%, which is going to feel terrible. It's not like you're not making any money now, but that'll be normal. You'll be back to a normal growth rate coming out of the market. So just again, this post is out on the website this morning. We've also got kind of the rules to follow, to kind of help you manage your money better. It's on the website now, realinvestmentadvice.com. Of course, it's where we post everything there. But again, just something again to just balance out the views around the world. Because look, there's a bunch of you in our chat right now. I'm reading is like super bearish. The world's going to end. And then, we've got people that are just uber bullish, right? So it's just, it's always important to keep an even keel and just remember that markets do work within a certain range of dynamics. And outside of that, you just have to manage that risk accordingly. All right, come back. We got a couple of things. John Penn joining me this morning. I'm sorry I just took that whole segment away from you. Apologize.
Good morning.
Should you just wait till after the presidential election to start investing? I got a couple of emails on this, and so did John. We'll talk about that when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The
Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. You know, hey, Alexa, ask a question.
Same show, your schedule.
I hadn't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So it is interesting because, you know, as you know, we talk about with you almost every day is, you know, this is what the market's doing today. And again, there's nothing wrong with the markets right now. They're completely fine. They're in bullish mode, and that can last for quite some time. We've also talked about the fact that, you know, hey, we're going to have a correction probably before the election. That's what the seasonal tendencies are in presidential election years. And it makes sense because, especially with an election like we're going to have this year, where it's going to be very contentious and no telling what's going to happen after the election one way or the other. You know, it won't be surprising to see Wall Street kind of risk off a bit going into the election. So, yes, the markets are going to correct from time to time. And it's interesting because we keep seeing people make the exact same mistakes over and over and over again. And again, John and I meet with lots of people every day. I just got an email this morning from a gentleman asking a question. He's like, hey, I watch your stuff all the time. It's great. Thank you. You know, I had a CD back in 2007. I missed the crash in 2008. And, you know, I kind of got back in, you know, around 2020, and I started kind of day trading a little bit. So my $200,000 is worth $500,000 now, you know, and, you know, it just doesn't seem like I'm really getting much of anywhere on a valuation basis. And I'm like, well, yeah, you're not. If you would have just put the money in, even if you would have just put your money in the S&P in 2007, lost half of it in 2008, you'd be ahead of yourself now just by being in an S&P index fund. And we've talked about this before, is that trying to avoid crashes and downturns doesn't mean you can't navigate them, right? But trying to miss them entirely leads to more capital destruction over time than actually just riding through the crash itself, because you miss so much of the upside on the other side, because you can't get yourself back in. You go through the crash and you just keep expecting that crash to continue to happen over and over again, and you can never get yourself back in the market. And so this is the challenge, right? And this is why investors do so poorly in the markets over time, is because they don't allow the markets to work for them, because they're always trying to outthink the market. And the markets are just a big collective of human nature. So if the majority of human nature is bullish, you need to be in that camp. When the majority of the human nature in the markets is bearish, you need to be in that camp, because that's what's going to drive prices, right? And trying to fight that and coming up with all these excuses and narratives and everything else that's going on out there is like, well, this could happen. Yeah, a lot of things can happen. The worst things never happen, right? And, how long have people been talking about dollar de-dollarization and the market crash? I mean, I can go back to 2009 and you can search articles of people talking about the death of the dollar, why this was going to happen, why that, why the economic devastation is going to happen. And it just never occurred, because the worst things never occurred. Are there corrections and things that happen along the way? Absolutely. But a thing like the financial crisis, which we don't have the makings for right now, happen very rarely. And they don't happen that often, and probably won't have another type event like that in my lifetime, maybe. I mean, it's certainly possible, but they just happen very rarely. 1929 type things, 2008 type things. They don't happen that often. Can you have big drawdowns in the markets? Absolutely, right? But again, waiting and say, I'm just going to wait till after it happens to invest, you're going to give up so much of your ability to make money. You might as well just buy the S&P index today and sit on it, ride through the crash, because you'll be better off.
Yeah, and it's to your point. There's always it seems like there's always a reason we as investors are making. Well, I'm going to wait till this happens. Well, we got a presidential election later this year, Lance, so I'm going to wait till that's over. Well, and then there'll be another reason. There'll be another reason. Well, and right now, John, well, hey, I'm earning 5% in my money market. This feels pretty good. Well, guess what? That's not always going to be there, right? So then what? Right, and and you go back to 2008, 2009, since the even Q1 of 2020, when we went into the economic shutdown, right? I mean, what a buying opportunity that was, right? Because I mean, look at all of the different investment types that went on sale, right? From an investor psychology standpoint, what's always amazing to me is, when folks, when you're out there looking to make a big purchase, if you're looking for a home or for real estate, maybe a vehicle, large projects around your house, typically you're looking for a deal. You're waiting. Hey, I'm going to wait for something to go on sale. Maybe you're trying to get a better value.
Well, at least if not, they're at least researching the crud out of it, right? I mean, they're my wife will drive all the way across into the Woodlands to buy something at $1 discount from where it is here, and I'm like, you just wasted more than that in gas. But the whole I got a deal on it, right?
Yeah, but I'm saving money.
But they don't do that in the market.
I know, but then markets pull back. It's like, oh, I don't want to go anywhere near. Well, hold on.
Yep.
Stocks and bonds are on sale. It's an opportunity. So, so to your point, some of the conversations I've had of late too is folks are, hey, they're concerned about the election year, right? And I get it. It's going to be, knock'em sock'em robots probably this year, right? We'll have to see how it goes. But, they're expecting, well, we're waiting for the big one. We're waiting for the big market pullback before we start investing. Well, what if that doesn't materialize? Right. So what would you say?
Well, it's interesting, because as you're talking about the election, I remember I was at Fox News on election night in 2016 when Donald Trump is running for president. And the consensus was that if Donald Trump got elected president, the market would crash. And as the returns were coming in, right, the market did crash. We were down like 500 points on futures as the election results are coming in. And before the evening is over, we're up 500 points and climbing, and the market never looked back from there. So there was all these people that were like, well, I'm out of the market because the market's going to crash. And it didn't occur, right? And so this is the problem with all these types of events that you think are going to happen, because Wall Street's going to game your system, right? Whatever you think Wall Street's going to game it. And if everybody's betting on a crash coming out of this election, I would be long going into the election, because odds are that's where Wall Street's going to be in there buying on a dip during election night, just like they did in 2016.
And let's think a little bit about the media too, right? Because there's always, their job is to put headlines out there that's going to draw you in. They want your clicks. They want to sell their ads. And do you think the nice and the fun stuff is what sells? No, it's more the doom and gloom. It's if it bleeds, it leads. Now, granted, not saying you need to discount those risks, right? I mean, you always want to keep your eyes on kind of what I like to call the risk horizon out there. What's going on out there? And Lance, earlier in the show today, you said something so crucial: invest according to your risk tolerance, right? So you have to kind of think about all that stuff with this. But there's always going to be a headline out there where it may cause you to go, well, I'm not ready to invest yet. Well, I'm not ready to invest yet. Well, I'm not ready to invest yet. So Lance, what would you say to folks? I mean, I know you visit with folks on a regular basis, as do I, that kind of got out of the market back during the last great financial crisis, and they're still sitting in cash, and they're just waiting. Is it better to try to wait for the big one, right? Or can you kind of nibble and kind of start to get some money working for you along the way? It doesn't have to be an all or none decision, but maybe start to get some capital deployed out there. So if markets have strength, you can at least participate. What are your thoughts?
Well, no, I mean, it's the reality is that we allow these big narratives to and fears, right? And this is called loss avoidance. This is one of our psychological bases of behavioral investing that keep us from making money. And if you'll just change your thought process, get rid of all of those kind of negative biases and stop worrying about what's on the news and what could this event cause and what could that event cause. If the market knows about it, the market's already priced in it. And trust me, if you think you know about it, the market already knows about it. Because remember, it's you versus millions of people that are investing on the same set of data every single day. So change your mindset from worrying about these big, massive events and when they occur to, can I make some money today, next week, next month? Because that's all we know. The best that we can predict in the markets is about a week. Right, we can pretty much, from a technical bias, know that within the next week, stocks should be roughly within this range based on technicals and historical price movements. Outside of that, it's a crapshoot, right? So if you say, look, I think the markets are going to correct, 10% going into the election, it's very possible. 10% corrections are completely normal in any given year. Historical statistics of presidential election years typically show a correction in September, October. Does that mean it has to happen? No, because that's the average. Right? There's years where the market rallied going into the election. There's years where we were way off way more than 10% going into the election. That's the average. But trying to predict that far out and say, well, I'm going to sit out of the market until November and see what happens, you may be so far behind at that point. Then you're going, well, the market's run up too much. I can't get in now, so you don't get in. And I'm going to wait for the next event to occur, and then I'll get in, and then that event occurs, and then it comes down, and then, well, it's going to keep going down, so I can't get in now because so you just get yourself in this whole trap. So change your mindset to, look, what's the market doing today? Can I make money? And if I can make money on an opportunity, that's my job as an investor. And when that opportunity is no longer present, then I need to reduce exposure. And this is why, we talk about here on the show with you almost every day. It's like, hey, we took profits in this. We reduced this position. We sold that position because it wasn't working. We made a mistake. That happens. But that's just portfolio management. And all we're doing is responding to what the market's allowing us to do and giving us opportunities along the way. So get rid of all these big macro views. You're not smart enough. I'm not smart enough to know when these macro views are going to matter or if they will even ever occur. Let's focus on making some money, because that's why you're listening to the show. Let's go make some money today in the markets. Let's think about that. All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So the race for AI chips is on. Intel just announced this morning a new chip for artificial intelligence. They're trying to play catch up now to AMD and NVIDIA, both of which NVIDIA and AMD over the weekend announced new AI chips. So everybody's coming out with a new AI chip now. It's the new thing. Semiconductor investing, hedge fund ownership of semiconductors has absolutely soared. I've got an article coming out on this next week, talking about, kind of these biases in the markets. It's interesting though, they've piled into semiconductors and sold off software. So it's now the AI chase is fully entrenched into hedge funds at the moment, and that's what they're buying. So just it'll be interesting. Intel's been lagging. It's been the redheaded stepchild of the whole semiconductor market as of late. And Intel has such a great history. Back in 1999, 2000, Intel was the semiconductor chip, right? And Intel was just soaring off to the moon. And it was like every day I would come in the morning. And in 1999, and it was great managing money because I literally come to work and I would just load up trades for like SDLI and JDS Uniphase and Intel and Cisco and put the trades in, and the market would open. They'd all be up, 20, 30, 40, 50, 60, 70, 100%, right at the open. I just sell everything. I was done for the day.
This is easy.
It was so easy making money. And it was a trader's market, right? But what was interesting is that I thought I'd see. Now here's one of my greatest investing mistakes, right? I was going to be a genius on this because Intel got to the point to where it's like there's no way Intel can keep going up from here, and so I bought puts on Intel that expired on the third Friday of May and February, and so I was like, this thing's gonna have a huge correction. I'm gonna make a ton of money on this. And I was right. The only problem is that Intel crashed in March, not in February.
Oh, yeah.
And so my options expired worthless, but my call was right. I was just a month wrong on my date. So, but again, we're seeing a lot of that same similarity in the market today. Go back to 1999, 2000. It was Cisco, Intel, Microsoft, Amazon, all those, not Amazon, sorry, Apple. They were all just kind of shooting through the roof. They all had huge corrections. Apple lost 80% of its value. Microsoft lost about 60, 70% of its value and took years. It spent years just going nowhere in the markets before it finally kind of got back on its feet. Cisco has not even recovered its peak yet. So it's still, if you own Cisco at the peak of the market in 2000, you're still not back to even yet. So just, we've seen all this before, and I'm not, and the juxta of the article is that, no, this isn't 2000, but there are a lot of similarities. And there's a lot of differences too. These companies all make money. They make billions of dollars now versus back then it was all on hopes of making money. But there are some similarities, and the whole AI chase is great. And the potential for it changing the world is fantastic. But what if it doesn't occur? What if something else occurs and we don't go AI crazy on everything? And I saw a great post the other day. Is like, I thought the whole purpose of AI was I wouldn't have to do laundry and dishes, and I could do, spend more time doing art and music. And now AI is doing the art and music, so I have to do the laundry and the dishes.
Yeah, right? You're cutting the grass and doing the dishes and everything else. Yeah, and maybe Cisco just needs to rename itself to Cisco AI. That would probably do it. That's what all the companies did late 1999 and 2000. Just say without .com in your name, and
just come out with an AI router. That's all you got to do is just, I've got a router that's AI driven.
Yeah.
Yep.
So what I'm hearing is, so when you're building a portfolio right now, you are not 100% AI.
Not yet.
Not yet.
We're not to the point. Well, two things. We're not to the point yet of being all AI in our portfolio. And also, we don't have AI driving the portfolio just yet.
Bingo.
Yeah, but I do qualify that with yet because it's probably coming at some point. But that does bring up another thing is I'm getting a lot of questions here lately because of AI, right? And everybody's out trying to raise money now. And I'm seeing a bunch of private equities being put together for AI investment space, right? The space is the next great frontier. As Captain Kirk said back in the 1960s, this is, where the chase is on, right? There's lots of money. People have a lot of money. Everybody's all excited about these themes. And if I want to capitalize on that, I can put together a private equity investment. Hey, give me your money, and I'm going to go invest in some of these private companies. I just caution you to be very careful with that.
Yeah, it's there is an allure to the private equity space, and how it's somewhat positioned is because when you say private, and we'll take a step back, a private investment is something that doesn't trade publicly, right? So so in your portfolio, you have companies of publicly traded stocks and bonds. They're very liquid. They're very easy. You can convert them to cash very easily. Even more so now, since settlement is now one business day, right? So if I need to raise some cash, or if I get in a bind and I need some liquidity, I can go to my portfolio and raise cash very easily. Well, the publicly, so the private markets, you can't do that. You put your money into a private investment, into a hedge fund. There's typically a lockup period there where they take your capital. That's just a fancy way of saying your money. They take your capital, then they put that to work in these underlying investments, and sometimes, those, it's like seed money, right?
Well, very importantly, the investments they're putting their money into are not publicly traded either.
That's exactly right.
Right.
So it may take, there's usually a lockup period because your money goes into these underlying investments that are not publicly traded. And these could be AI, this could be space themed, it could be anything. It could be land, property, buildings. You could be investing in private loans in the private lending space. But these are typically investments that are not easily converted to cash. So typically these private investments, they have what is called a lockup period for maybe 6 or 7 years or more, where you are not going to get your capital back. Right.
And there's also a bigger overriding theme to private equity is that if you personally, like you're listening to the show right now, me and John, right? If you're approached by someone saying, hey, I got this really great private equity deal, you need to really spend a lot of time researching what they're investing that money into. And here's the reason why is that most private, if somebody comes to you and says, hey, I'm going to invest in space, right? I've got a private equity fund. We're going to invest in all these space these companies, and they're going to go into space. That's fantastic. But most likely, and look, there are some huge equity players, private equity players in the markets, and they manage trillions of dollars. The best deals, they've already funded them. If there's a really good deal, and if there's the next Tesla, right? If the next, Elon Musk just raised $6 billion for XAI. It took him like one phone call. So, hey, I need some money. Okay, here you go. Because he has a track record, right? But the best deals are being picked over and fought over by these massive private equity companies that have massive research capabilities. They have all the connections, all the right people. And so they get the best deals. The stuff that you and I are most likely approached with, and this is why you have to be careful. Now, just fair disclaimer, I do personally, I do some private equity, right? But I know the space very well. I research it, and I have very tight controls. I also dictate a lot of my own terms. So that's okay, and there's nothing wrong with that. But if somebody just approaches you out of the blue and says, hey, I got this private equity deal, and they give you a memorandum that's like 400 pages deep that you've got to read through, you've got to really read those, because there's all kinds of risk disclosures in there about you losing all of your money, your ability to get your money back. And you got to understand is the deals that they're investing in, right? Why do they have those deals? If those deals are so good, the first question is asked is, why didn't Goldman or Sequoia Capital or any of these other big private, why did they not invest in it, right? Because I'm sure they saw it. They see everything. They have people all over the country just knocking on doors looking for deals because they've got so much capital to place. So again, there's nothing wrong with private equity. I don't want you to take away from the conversation that you shouldn't do private equity. You just need to really be aware of the risk that you can lose all of your money. You could be locked up for years and not get your money back if you need it. But also too, just ask the obvious question, which is, why am I so lucky? Why are you approaching me, a guy with $1 million to invest in private equity? You have to be an accredited investor. So you've got to either make $250,000 a year or have over $1 million to invest. Why am I so lucky? And then also think about how much capital you're putting at risk. If you're putting a quarter of your money or half your money into private equity, what would happen if you need capital for some point? Something happens in your life and you need capital. You can't get to it.
Yeah, and that net worth of over $1 million to be one of the qualifying factors to be considered an accredited investor, that $1 million is excluding the value of your primary residence. That does not count as being part of an accredited investor. And so many great points there, Lance. Within those in the private equity space, because the underlying assets in those structures are not publicly traded, it's hard to go out there and research them. Right, to figure out, okay, what is this fund actually going to invest me in? What are the underlying assets? And if we do get into, a more challenging economic environment, am I going to be stuck with an investment that's supposed to provide me some cash flow, and all of a sudden it's just a dead investment and I can't get my money out for 6 or 7 years? Mm-hmm. Those are all things that you have to think about when exploring these. And again, not saying that private equity or sometimes alternative investments are bad. If you add something like this to your portfolio, you just want to make sure it's all about balance. Don't put 50, 60, 70% of this of your portfolio into that, obviously, right?
And again, I cannot reiterate them enough. Just ask yourself the obvious question.
Absolutely.
Why are you so lucky? All right. Thanks, John.
You bet.
Appreciate it. Be back tomorrow with Danny Ratliff, I think. Who's here tomorrow? Okay. Yeah, I know he's getting ready to go on vacation sometime. So, yeah, I know. Not me. Yeah, a bunch of lazy people. Anyway, actually, I'm going to be on vacation after July the 4th, going to Greece with the family. So, y'all just stuck. All right. Anyway, have a great day. We'll be back tomorrow in the next edition of the Real Investor Show. Be sure and like and subscribe to the channel. We appreciate it. Get the latest blog post on the website right now, realinvestmentadvice.com. See you tomorrow.